Good morning, folks. Welcome to today's lectures. Um, Looking at the chart, Nasdaq chart, this daily chart, we could see the daily fair value gap I outlined on the last previous video I made for this week price anticipation. That's the caption for the video. You could see we are outlining this fair value gap for a price delivery. Then after that, we could see a run up and this buy side liquidity. This is the minor daily buy side liquidity and the major buy side liquidity over there for this week. Today being Thursday already, maybe probably next week we could see a price run over there. Yeah, we have a daily buy side liquidity over here too. This is a minor buy side liquidity too. It's a minor buy side liquidity. That's the daily buy side liquidity at that high. You see, price has swept the high. You see a delivery taking out the low. That's Tuesday low. That's Wednesday candle. This Thursday candle. That after sweeping the low of Tuesday, that's Wednesday sweeping the low of Tuesday. We could see a run up there going to Friday high. That's the last week Friday close. You see a price running up to the high. That's a buy side liquidity, a minor buy side liquidity. As an order block. The last close candle, bearish close candle. If we are bullish, so we are looking at every last bearish close candle to act as an order block. That's at the opening of that candle body, not the wick. At the opening of the candle body. That's your daily order block. It's the daily order block. You have to note that price delivery inside the daily fair value gap for the secondary delivery. That's the first delivery, a partial entry, sweeping the low of last week Thursday as a sell side liquidity that I also outlined it in the previous video. You have to take your time and go and watch the previous video before this. That's the sell side liquidity, a partial entry, see a rejection block. On Wednesday, we could see a secondary delivery sweeping both the low of the Tuesday sell side liquidity, that's the rejection block, then deliver at the lower quadrant level, crossing the 50%, that's the consequent encroachment. Between this high, the week high, and this low there. That's to get your 50%. We are looking for the 50% level. That's the Fibonacci. 50% Fibonacci level being the consequent encroachment. That's 0.5, which is the 50%, and we have 0.35 and 0.25 being the quadrant level. That's the half of the consequent equation. That's the quadrant level. could see the price delivery at that lower quadrant of this inefficiency. That's the daily fair value gap. The lower quadrant, that's where price deliver at. You could see a run up rejection block also. We have been the daily order block, and we see a rejection block there. That's the rejection block. The long wick. You have taken the sell side liquidity. That's why you see the run up to the buy side liquidity. What you are looking out for is liquidity. Once a liquidity is taken in higher time frame, price will seek for the opposing liquidity, which is the buy side liquidity. And if by today we trade above this high here with candle body and close above the high, then we like to see price create a fair value gap coming Friday candle to create a fair value gap for a possible price delivery next week, then a run up to this high here and this major daily buy side liquidity. That is a fair value gap, and have a volume imbalance over there. The high and this low. That's a volume imbalance. We could see there is a void, a gap between those two candles, a space there. That's a volume imbalance. Volume imbalance high. We have a volume imbalance low here. That's the volume imbalance low. Then we have volume imbalance low. This is for next week delivery, price delivery. Today is already Thursday. But what could we anticipating coming Friday, being tomorrow, for this run up at this high here, this daily minor daily buy side liquidity. Before then, once we trade above this high with candle body, I want to see it trade above this high with candle body to get a 50% of this candle wick. This is a wick. The 50% of it is a major premium or discount area. Use your Fibonacci. So what we are looking for now is just only the 50% level. That's 0.5 level. That's the half of this week, this daily week here. 50% of it is a major premium or discount area. It's also a PDR. You can remove your Fibonacci. Here is the daily week. %50 level. That's daily week 50% level. That's for daily time frame. For daily time frame, go over to 4-hour time frame. Over here in 4-hour time frame, we could see this inefficiency as a fair value gap. As price have swept the high of the minor daily buy side liquidity, you see price running up to this, taking this low, then a possible price delivery inside this 4-hour fair value gap. That's the new week opening gap. I also outlined this new week opening gap in the previous video. That's the gap between Friday and the Sunday midnight opening. This is other trend line. A new week opening gap. That's the consequent encroachment, the 50% of the new week opening gap here. And over there is the daily minor buy side liquidity that we taken, that we swept. The buy side have been swept. I also outlined it on the previous video. Here is the daily week 50%. That's the half of the daily week, which is this level here. You could see this 4 hour. That's 4 hour fair value gap between this low. You see the rejection block at the new week opening gap, consequence encroachment. After price must have traded above and closed with candle body. The 50%, that's the consequent encroachment of the new week opening gap, has been validated with candle body. The body will give you the narrative, tell you the narrative. What you are looking at for is the body and close above the consequent encroachment. That's the line over there. That's the half of the new week opening gap that's been validated with candle body. So price coming back to it again now acts as an inversion. We treat it as an inversion. That's why you could see the rejection block at the consequent encroachment there. The 50%, that's the consequent encroachment, has been validated with candle body. You could see the first delivery, that's the first touch. It was rejected, that's the rejection block. The second delivery, that's the partial entry there. Then coming to it again for the third time, the candle body close above the consequent encroachment, that the half of it has been validated. So it now acts as a support level. That's a discount area now. You treat it as a discount area at this level now. Before it has been validated, it's acting as a premium level. That's premium level above, then discount below, acting as a major premium level. That's why you could see this rejection block for the first delivery. Then the second delivery, a partial entry inside the half quadrant of the gap. Then the third delivery, we validated the consequent encroachment at the 50% level there. Then you treat it as inversion, the consequent encroachment, the half of it. Now it's going to act as a discount area for future price action. You have to treat it as a discount area. And we have over here, this is a 4 hour. Between that week, the rejection block there, low. That's the low of that candle. And the high of this candle here. That's the 4 hour fair value gap. Low, 4 hour fair value gap. That's the high over there. That's the high and the low between that rejection block candle there being the weak low, being the 4 hour fair value gap that created the 4 hour fair value gap because we are in 4 hour time frame. And here is the high. So you could be anticipating for a price delivery inside a consequent encroachment. So to get a consequent encroachment of this inefficiency, which is fair value gap, you anchor from the low that's being high now, the high of it, because this is the candle that created the fair value gap. After a validation above the new week opening gap, we had a rejection block. This is the candle that created the fair value gap. So you are anchoring from the low of that candle being the high of the fair value gap to this high in the low of the fair value gap. The line over there, that's the 50% level, 0.5, which is 19979 level. That's the consequent encroachment for this inefficiency over here. So you can annotate it, then you can remove your Fibonacci. That's the 4 hour consequent encroachment, which is here. Here is the new week opening gap, and here is the consequent encroachment. And this is the candle that validated the new week opening gap, coming back to it again, acting as inversion, as a discount area, for acting as a premium area before the candle body validated the half of it at the 50% level. Now it's now acting as a discount. It treats it as a discount area now for future price delivery. Go over to 1 hour. Yeah, on this 1 hour chart, the daily buy side liquidity swell. Note that here is the new week opening gap. You see the price action on the 1 hour, this 1 hour chart. Second delivery, then the third delivery, then the here on 1 hour you see the candle body that validated the new week opening gap in 1 hour, then creates a fair value gap. This is a fair value gap. This is a high probability. And enter here, then you put your stop loss over here. You target the high, which is the buy side liquidity above, and it has been swept. Yeah, this is my favorite setup. An inefficiency inside an old inefficiency. That's a fair value gap being created inside a old fair value gap. If we are long, if we are bullish, once price trade inside it at the 50% level, I'm entering. Then putting my stop loss at the candle that created the fair value gap. Then targets the draw on liquidity, which is a buy side liquidity if we are bullish. Same thing if we are bearish. That's the daily week. The daily week, the line over there. You see a fair value gap there. It's going to act as an order block, last close candle. That's the daily week. After a breaking above the daily week, which is acting as a premium level with candle body, now it's going to act as a discount area. That's why you see the rejection block there. That's why you see the rejection block. So price coming back to it again. Why it has created a fair value gap. It will only deliver inside this fair value gap, then target the high of this major daily buy side liquidity over here. This should be our target for this week. For this week liquidity delivery above that. That's a nice price delivery. So thank you for watching. Also note this fair value gap, this 1 hour fair value gap. Note this fair value gap over here. As a 1 hour fair value gap. As CBC, buy side inefficiency, sell side imbalance for future price delivery, future price action. Then the 50% of it, we anchor it from the candle. This is the candle that created the fair value gap. So you because we are bullish when the fair value gap was created, price created a fair value gap. So you are anchoring from the candle, the low of that candle that created a fair value gap to this candle high. And we have a high here also. So you're going to make use of this high and this candle low. Since we have a high here and a low here, so we are making use of this both. It should be a possible price delivery at the consequent encroachment there. This could be a sign. So you could see this as 1 hour fair value gap low. 1 hour fair value gap high. That's a high. So you are going to get the 50% between this high and this low. That's what we are looking at for now. You anchor from there. So yeah. You place it at the same 50% level. That's the 0.5, which is the 50% level of Fibonacci. And remove your Fibonacci level. Now this is your 50% level. As a consequent encroachment. So waiting for a possible price delivery inside the consequent encroachment. Then we see a run up at this minor daily buy side, sorry, major daily buy side liquidity. That's a major. The minor daily buy side have been swept. You can see the little move up there to move up that is swept. So when you go to your lower time frame, go to 15 minutes. Just how you can pyramid to be able to trade, to enter your trade. You have an inefficiency here too, and this is a low. It's a possible price delivery. Then coming to this 1 hour fair value gap as a, on 15 minutes, this is a breaker. Up close candle, you treat it as a breaker block. As a breaker block, is how you get your breaker block. The last bullish close candle, since we are bullish, this is the last close candle, up close candle there before a break above. Then after a break above, that's been a breaker now, break of structure. The last up close candle that you treat it as a breaker block. Then this is a possible price delivery at this fair value gap here. You watch for price to trade inside this fair value gap, taking this set side liquidity. Then we will see a run up there at the high, maybe going further part two, just up there. Today is Thursday, and not yet 9:30. Maybe by 9:30 opening gap, we could see a price delivery inside this fair value gap that created after a breakup structure there. That's your breakup block. Now on 15 minutes, you choose that. That's your breakup block. Other block there. That's another block. We won't like to see price trade above here again. Price coming to trade and feed this 1 hour inefficiency. Then take this low, this last close candle here. It's a set side liquidity below there. When you go to lower time frame to 5 minutes, you could see that's a low there, and a set side liquidity here too. Which will be a possible price delivery going into 9:30, then into Friday. Today is still being Thursday. You see that in 5 minutes you have a consolidation there. As a consolidation before you break above. You see a fair value gap there too after a break of structure. So we want to see price trade and fill this gap and trade inside this 15 minutes. This 15 minutes breakup block. So we have to note that you study have a fair value gap there. We would like to see price trade above there again, but we like to see price trade down, break below. This 5 minutes time frame. So each candle you see here is 5 minutes open and close within 5 minutes interval. And this London session delivery, from this here over to that as 2 a.m. to 5 a.m. delivery to take the minor daily buy side liquidity. At this time of the day, that's the macro time. Price will seek for inefficiency. It will seek for a liquidity resting above or below. So that's for today. So thank you for watching and put your effort and your time studying price action. You only study look out for liquidity. Liquidity is what matters most. So that's what you are looking out for. Once that is taken, then you look out for opposing liquidity for a possible price delivery too. So thank you and God bless you. Be safe.